Hello, everybody, and welcome to our show today. So today we're going to be talking about Dun & Bradstreet business credit reports, and we're going to be diving in and talking about 10 individual factors that you should know about that are things that affect your business's ability to get financing, to get credit, and to build business credit, all of which are on your Dun & Bradstreet credit report. So if you're watching this live on YouTube and you like this topic, this makes sense, then please make sure that you like and subscribe. And also feel free, if you're listening to this on our podcast, to leave us a review. And if you're watching on YouTube, don't forget to follow our podcast. You can go to creditsuite.com, and at the top right of our page, you can access our YouTube channel where we've got hundreds of videos that teach you all things dealing with business credit financing. And then you can also access our podcast, Instagram, our Facebook Lives, and a lot of other cool things. So for those of you that don't know me, my name is Ty Crandall. I'm actually the CEO here at Credit Suite. And if you have any questions along the way, since we cannot answer questions in these live sessions, then feel free to give us a ring, 877-600-2487. That's 877-600-2487. And the email is info@creditsuite.com. So let's dive in. So Dun & Bradstreet. Dun & Bradstreet is the oldest and largest of the credit reporting agencies. As a matter of fact, when we talk about commercial and consumer. So it's still interesting. I talk to a lot of people that still don't know what business credit is, aren't sure of the legitimacy of business credit. But the reality is that Dun & Bradstreet was around over 10 years before the first consumer credit reporting agency ever showed up on the scene. 5 U.S. presidents have worked for them throughout their history to kind of give you an idea of how long they've actually been around and the type of credibility that they have. Now, with Dun & Bradstreet, you have to have a DUNS number to start building business credit. And this is a really big deal. A lot of people ask me the same question. They say, I have accounts that are supposed to report to Dun & Bradstreet. They're not reporting. What do I do? Well, in those cases, a lot of the reasons that they may not be reporting is that you need to have a DUNS number to start building business credit with Dun & Bradstreet for them to ever populate a report. And you really need to have 3 accounts reporting with them forever for you to have a report established. So the DUNS number, they're absolutely free. You can go to creditsuite.com/DUNS. It's a shortcut to Dun & Bradstreet's link to get it. You can also go right to and just do a Google search for free DUNS number and get it that way as well. So that number gets your business into their actual system. The process to set up a DUNS number takes about 5 to 10 minutes online to do it with them. And once you have that DUNS number, then some credit issuers will ask for it when building business credit. Others won't ask for it when building business credit, but it is necessary for you to ever have a credit profile established with Dun & Bradstreet. Now, Dun & Bradstreet, their main score is called the PAYDEX score. Remember, in the business world, all these business credit reporting agencies have multiple scores, about 5 scores that you can see on the credit report, but their main score is known as the PAYDEX score, and it basically it's basically a score that's populated based on your past payment performance. So Dun & Bradstreet has 2 kinds of scores, ones that are called performance scores, which rate you based on past payment history performance, and then other ones that are called predictive scores that predict your future risk, taking a lot of different information into account. Now, as I mentioned, in order for you to have a credit score populated with Dun & Bradstreet and a report populated, you've got to have the DUNS number. You have to have those 3 trade lines. So you need both of those to have that report and that score populated with Dun & Bradstreet. Now, one of the first things a credit issuer is going to check when deciding whether to extend credit is Dun & Bradstreet in a lot of different cases, because they offer actually a database generated reports, which are reports for basically all the businesses that are in their database. And these help their clients, which are typically lenders or credit issuers, decide whether a business is a good credit risk or a bad credit risk, whether should they lend you money, what rates and terms should you pay, how much should they lend you money, etc. Now, companies use these reports to make informed business credit decisions and avoid bad credit as well, right? So they use business credit reports the same as consumer credit reports just to make sure that they're making a good lending decision and that they're lending to somebody that actually has the financial responsibility or has the ability to pay back the actual debt. Now, several factors go into creating those reports, and these will be some of the things that we're going to talk about today. So in general, when Dun & Bradstreet does not have all the information they need, well, they'll indicate that in their report. They'll put that they don't have enough information to be able to calculate a score or to be able to populate whatever that information is on the profile that should be populated. However, missing information does not necessarily mean a firm is a poor credit risk, although it sometimes can be seen that way and sometimes put you into a higher risk category. So sometimes the risk is unknown, but a lot of credit issuers and lenders will still see that as a higher risk. Now, any report is only as good as the information that it comes from, right? So D&B's database has over 250 million companies around the world. It includes over 120 million active firms and about 130 million companies that are out of business. So they keep information on file even for businesses that no longer exist, and they keep those for historical purposes if anybody is choosing to look into it. So something you should know, that even if your business, you close your business for any reason, Dun & Bradstreet still keeps an active profile of your business. Now, D&B continuously gathers data, and then it works to improve its analysis or its system to assure the greatest degree of accuracy possible. This is the way all reporting agencies are, and they tout this, right? That they have the newest, the greatest, the best way of analyzing risk because, for example, Dun & Bradstreet is competing against Experian and Equifax Commercial. So to ensure it's accurate, as possible, it quite literally pays to make sure that that's the case. So to provide D&B with your current company's financial statements, for example, is something voluntarily you can do to give them the information so they don't have to get it elsewhere. And this actually also will affect the type of risk ratings that you're in. And I have like a chat popping up here, so I'm trying to get that closed out. So that actually will affect the risk rating that you're in. So D&B actually has different scores that gauge your financial risk, and these scores you can be put into different categories and be lower risk just because they have your financials, because you've supplied your tax returns to them. So this is very interesting. In the consumer credit world, that's not the case. You know, credit issuers, lenders give the data to the credit bureaus. The credit bureaus use the data that they're given to populate your scores. In the business world, you do have some control over this. So if you have tax returns that are positive, that show hopefully some kind of profit, well, then it's worth it for you to be able to supply those tax returns to Dun & Bradstreet to make sure that you can get a rating that's reflective that they have your financial risk. What's also interesting here is that if they don't have your tax returns, they rely on the number of employees to determine that exact same score. So basically, if you have some of the scores that D&B provides, they're going to look at your financial risk of defaulting, and they're going to take into these predictive scores the information they have to determine your risk of default. Well, they're going to look at your financials if they have them. If they don't, they're going to look at the number of employees you have, and the fewer number of employees you have, the higher risk that you actually are with D&B. So D&B starts with self-reporting by you, right? When you fill out credit applications, the information that you fill out is reported to Dun & Bradstreet. And this is why whenever I talk about business credit building, I really talk about the importance of making sure that all the information you put on your application is the same everywhere that it is listed online. Your business name, your address, your phone number should be the same on the application as it is with the Secretary of State and the same as it is with even Yelp. And you'll learn more about that in a second, or in a few minutes here, because again, Yelp is even a place that D&B goes to get their data. So it starts with the self-reporting by you. The information you're giving them on a credit application or a credit issuer or lender gets reported to D&B. So the amount of time you've been in business, the industry classification, the number of employees you have, etc. A lot of this stuff can come from these initial applications. That's where it starts to come from. But also, don't forget, as we'll talk about, this information on D&B reports comes from a lot of different places. So for example, the amount of time you've been in business and the number of employees you have also comes from the Secretary of State records. The industry classification you have comes from your tax returns. So again, you can provide a lot of information that will then end up populating onto your report based on what you're putting on these applications, based on the tax returns, but also keep in mind that they're also going to be getting information from other sources, such as the Secretary of State, which also will show this information, even if it's not supplied by you. So also includes voluntary reporting by creditors or credit issuers, right? So it's an advantage for creditors to report, because if people report report your payments, well, then they know you report. So again, some borrowers may pay faster. If you know somebody's going to report your positive payment history to the reporting agencies, you're more prone to pay as agreed, for example. So there's a reward if they do report your credit. And again, they can reward, good credit, conscientious borrowers. If you're paying your bills as agreed, you get a reward for building positive business credit. And there's also reporting alerts. So if things change on your account, you're late 1 month, well, then other credit issuers are alerted of that. So then that way it makes it easier for them to be able to then pull back credit that you've been extended because you're late. So there's a lot of benefits for credit issuers and lenders to report, but it's not voluntary. So a lot of credit issuers and lenders don't report. As a matter of fact, it's estimated that over 97% of trade vendors do not report to the Business Credit Reporting Agency, even though there are these advantages. So D&B also gets information from public record sources, such as bankruptcy, liens, judgments, etc. And this information is often from court documents. So keep that in mind. Beyond that, lawsuits is included here. Again, we're not used to this. If you get sued as a person, as an individual, that would never show up on your credit report. But in the business world, bankruptcies show up, liens show up, judgments, and even lawsuits will show up on your actual credit report. So public records is one of the sources that D&B uses to get this data and to populate this data onto your actual commercial credit report. Now, they're also getting information from the IRS, things like tax liens. Whether you're in the entity that you are, that information can come from them. The makeup of your company, the hierarchy of your company, if you're a division of the company, for example, these type of things can come from the IRS and the Secretary of State. So that's a source that D&B gets data from as well. And then there's also shared data. So the credit reporting agencies, it's not uncommon for them to get data from other reporting agencies. Okay, we even know of reporting agencies that get customers' payments and report it to the big three reporting agencies, Experian, Equifax, and D&B. So again, they have information from lenders and suppliers and credit issuers and vendors that report and other bureaus that report. All of these are sources of where they get the data that goes on to your actual D&B credit report. Now, they get it from collection filings as well. So the date of a collection, the status, the collection agency name, the amounts disputed and collected, and the close date if applicable. So anything to do with collection companies supplying data, this information comes from them as well. Okay, so another place is called UCC filings. Now, if you're not familiar with what a UCC filing is, UCC filing will file, a UCC filing is where a lender is notifying, for example, the Secretary of State that there is a lien against an asset. So if you get a lot of loans, a lot of business loans will report a UCC filing on your actual credit report. It alerts people, other people that look at the credit report, that you have an actual outstanding loan. So they get sources from these UCC filing records as well. The media, okay, news stories, press releases, anything online and offline. D&B has all kinds of crawlers that crawl the web. And a crawler is something that, just what it sounds like, it crawls the web for looking for information on particular companies. And a lot of that is what they're getting data from, some of which can be on your commercial credit report or make it to your commercial credit report. The federal government, okay, company grants, loans, contracts, debarment, okay, which means exclusion from certain items such as contracts due to transgressions like fraud. These type of things can be put as alerts on your credit report as well. It's all kind of crazy stuff. So for example, I saw an alert the other day on somebody's credit report where they hadn't bought trade lines from a trade line company, but the trade line company was pulling their business credit report, a company that sells trade lines, which is a big no-no in the business world. And the company that sells trade lines didn't even sell the person a trade line. They were pulling their business credit report, and that resulted in an alert. Why? Because somebody that sells trade lines gets on D&B's radar, and D&B oftentimes shuts down all the credit profiles from those that had those companies' trades because they know they're bogus trades. So even the fact that somebody didn't even control it, had somebody pulling their business credit report that they didn't even control made it as an alert on the credit report. Okay, business registration, so your incorporation, the date of incorporation, the current status of your filing, all makes it to your commercial credit report. So when you file annual reports with your Secretary of State, it's important to know that a lot of that data gets on your credit report. So think about it. You put your founded date in there. You put your industry in there. You're putting the number of employees you have in there. All those type of things can make it to your business credit reports. Okay, so business registrations, again, in the state level, a county level, a city level, occupational licenses, industry-specific licenses, all of this information is readily available for D&B. Now, again, all of this won't populate on your credit report, but it's used to pull certain amounts of information from. So, for example, an occupational license or an industry-specific license is something that tells them the industry that you're in. So that's one of the places that they can go to even pull something like the industry that you're in's information from. Incorporation filing. So again, if you filed anything with the state, shareholder documents, financial reports, even your initial entity when you set it up, any of those type of things, the D&B and Experian and Equifax get data from that can end up populating on your credit report. So directories as well, Yellow Pages, Yelp, all of these type of places are where the reporting agencies get data from. Again, as I mentioned, the problem with this is that this is why you have to make sure that all of your information online is congruent. The name, the address, the phone number of your business needs to be the same at the Secretary of State as it actually is with Yellow Pages, as it is with your website, as it is on the application. Because if they're pulling data from all these sources and they find inaccurate or different information that's different, well, then that can create all kinds of issues. For example, like multiple DUNS numbers being created. So a DUNS number is based on a business name and address. Basically, every unique business with a separate location to D&B. So if you have different addresses and you change your address and there's different listings online for your business at different addresses, D&B can easily create 2 credit profiles for you, making it to a point where you're more difficult to get financing and credit, and to a point down the road where you're going to have to merge these profiles and scores. So a very important point here. Your name and your business address, those 2 factors combined are really how businesses report data to the reporting agencies about your business and where they're able to pull your business credit reports. So if I want to pull your business credit report right now, all I need is the name of your business, and I would say the address, but I don't even necessarily need the address. What I really just need is I just actually need access to the state that you live in. And this is very important because, again, if somebody even wants to report your payment histories to the reporting agencies, they don't even need your EIN number to do it. And if they want to pull your business credit report, they don't even need your EIN to do it. So the reason I'm telling you this is because the address that's linked to your business is extremely important for multiple reasons. If you've ever changed addresses, you need to make sure that all the information online is congruent. We use a service called Yext for this, Y-E-X-T, but there's a lot of services out there that are similar. And what services like Yext, and D&B even has a service for this as well, what they do is they automatically change all of your online listings, update it to the data you tell them is accurate. So instead of you going to Yellow Pages and all these different sources and Yelp, they actually have one place you can do it, and it upgrades at every single place. So there's a lot of benefits of using those type of services, especially if you've been an established business that changes some things like your address. Credit reporting agencies will also look for your company online, okay? Google, your website, your company presence elsewhere, Yelp, Facebook, etc. So this is why you should have a really good website, and your website should have a good amount of information on there about your actual business. Because again, you'd rather credit issuers, lenders, and the reporting agencies get data about your business at your hand the way you want it to be than other information that's in all these other places that it could be. So make sure you have a good website. Make sure it has all the information about your business. Make sure that your Yelp and your Facebook, these listings that you control, make sure they have all the same information. Google has a place, Places for Business, Yahoo, they all have have places for free, Bing, that you can set up a profile for your business and you can control the information, your business name, your address, your phone number. First of all, by setting these up, that can attract business to your company. So it's like free listings. And the second thing is again, the reporting agencies are getting data from these sources. So you want to make sure that you set them up to control the data that they're actually seeing. So D&B, if you want to have a company website, again, that allows you to control the narrative, and it can, otherwise they're going to go elsewhere to get that information. So factor number one that we want to talk about here is called the delinquency predictor. We haven't even talked about the actual 10 factors. I just want to give you a bunch of background and additional information as well that can help you. So factor one, delinquency predictor. Now, D&B uses what are called, again, predictive models. And predictive models take information into account like past payment performance and financial data like your tax returns or number of employees to basically predict your risk of default on future different types of financing that somebody may give you. So again, there's kind of two types of scores people can look at. And in a lot of cases, they basically say the same thing, but one predicts your risk based on other factors and one's only based on payment performance. So delinquency predictor is predicting your risk of future default based on things like past payment performance. So the idea is to take the statistically derived data that they have, okay, and then from that come up with the prediction of how you will basically pay your future obligations. Now, again, it's used on their algorithms and all these different types of data sets that they get. It's not just based on your past payment performance. If this was a delinquency performance indicator, then it would be looking at what you actually have done in the past and giving you a score solely based on what you've done. But the delinquency predictor predicts your risk, taking into account multiple different forms of data to be able to do so. So the scoring ranks and orders accounts based on the probability of late payments. How probable are you to pay as agreed or not pay as agreed is what it's ultimately looking at here, okay? So it also attempts to predict the future outcome of how you will pay. And again, you have no historical data as a new company. So look, if you've ever heard that by not having business credit established, you look like you're actually at risk of going bankrupt. It's very, very true because the reporting agencies look at a business that doesn't have historical payment information reported to them as a very high risk because that company has, the further they are in being established without building any kind of commercial credit, the higher risk that is because there's reasons in their mind that you're not establishing credit, possibly because you're not able to obtain credit. So again, not having historical information can again even make you a high risk when there is no payment information that's supplied to them. So again, we just take a look here at one. Let's take a look at the financial stress percentile score. Now, the financial stress percentile score basically compares your company to other businesses. So all these reporting agencies have what are called these percentile scores. And what a percentile score is it's where do you rank percentage-wise against other companies in your industry. So if you're an accounting firm and you have a good business credit score, how good is your score compared to the other accounting firms in your industry based on a percentage? Are you the top 10% score-wise of all people in your industry? Are you the top 50%? So again, what it's looking at is that if you have an 80 PAYDEX score, a good PAYDEX score, how good is your score compared to all other people in your industry? So they're looking at region, they're looking at industry, they're looking at comparable businesses with size, meaning the number of employees you have, the years of business, et cetera, et cetera, et cetera. The financial stress score norms calculate basically an average score and percentile for similar firms. So again, these numbers are the benchmark. They're looking at all data from one industry segment, and then they're basically saying this is where your risk is compared to everybody else in your industry. Meaning that, hey, look, maybe accounting firms have a higher risk of default than other industries. Well, this gives people the ability just to look at an industry and look at your payment performance against others in your industry, so they know not how you rank against all other people in all other industries, but how you rank against your peers in your exact industry. So now the delinquency, again, the delinquency predictor, this score is designed to predict how likely it is that a business will fail. And excuse me, it says delinquency predictor, but this actually is the financial stress score. So the financial stress score is basically just looking at your risk of defaulting and going bankruptcy. And this is very important because, again, financial stress scores, from what we see, they will actually be very high risk if you have no credit. So this is a world where Experian and Equifax will even populate credit reports for you with no trade lines and give you a very high risk bankruptcy predicting score because they see you as high risk with not having any credit established. And there's a lot of different ways that we can look at how they defined business failure, seeking legal relief from creditors, stopping business, voluntarily withdrawing from operations. The bottom line is your business has basically failed. Bankruptcy or you have went out of business is basically what they're looking at here. Okay, so D&B scores range from, with this bank or with the actual financial risk score, they range from 1001 to 1875. A score of 1001 represents the highest probability of failure, and 1875 is the lowest score that you're going to see. So delinquency predictor, D&B scores your company. The numbers range from 0 to 5, and 1 is the business least likely to fail, and 5 is the most likely to fail. Okay, so now a D&B customer can quickly divvy their new and existing accounts by risk and then decide how to proceed. So what about a 0 score? Well, a 0 score automatically shows high risk, possible open bankruptcies or discontinued at this location. So that's the biggest score you can get. Now, the financial stress score percentiles, again, we've talked about this. We know financial stress score indicates your risk of defaulting. We know percentile score has to do with your percentage against others in your industry. So financial stress score percentile is just that. It's your risk of defaulting and going out of business altogether in a percentile against other people in your actual industry. Now, this score ranges from 1 to 100. A 1 percentile is the most likely to fail. 100 is the least likely to fail. And again, it's comparing you against other people in your actual industry. So again, they're looking at financially stressed to ceasing operations, voluntarily withdrawing from business. There's a million ways I can say the same thing, but it basically has to do with the fact that you either filed BK or you went out of business is what they're looking at. So they have what's called a SIR rating, a supplier evaluation risk rating, also called a SIR rating. Okay, it's 1 to 9 is the score, predicts how likely is that your company will get legal relief from its creditors or end operations without paying creditors over the next 12 months. So what's the difference between this and the financial stress score? This is for suppliers. That's what they're looking for. So this is basically for is it rates suppliers' risk. So let's say that you order, in order to do business, you need widgets, and you order widgets from a widget company. Well, that widget company is supplying you with those widgets. So the SIR rating is so you can know, or do you feel safe giving the widget company your money? Because you don't want to give the widget company your money and then get a notice that they went out of business. So this is basically for suppliers. It's for you to know that the people supplying you whatever it is you're getting supplied, in this example, widgets, has a risk, or had the risk of them not delivering once you've paid. Okay, because the last thing you want to do is give somebody $10,000 to supply something you need to produce your product, and then they go out of business and you're out your 10 grand. Well, this is a way for you to find out from people that are your suppliers what their actual risk of going out of business is. So once D&B calculates a financial stress percentile on your company, they apply a second set of rules to figure out this SIR rating. A 1 means your company's least likely to fail to pay your own suppliers. A 9 is the opposite, showing the highest likelihood. So again, that's really what we're looking at when it comes to the SIR rating. Now, credit limit recommendations also on D&B, Equifax, and Experian credit report. So a D&B credit limit recommendation includes two recommended dollar guidelines. A conservative limit, it suggests a dollar benchmark of a company's policies to extend less credit to minimize risk. And an aggressive limit, it suggests a benchmark of a firm's policies to extend more credit with potentially more risk. So this is extremely important. I say all the time when I talk about business credit profiles and scores that your business credit, when it comes to getting loans, will help determine three things. One, it will determine whether you get the loan or not. Two, it will determine the amount of money that you will get. And three, it will determine the rate and term that you will pay. So for example, if you are very high risk financial stress score, which shows you could go bankrupt at any time, your chances of getting money from the banking system and a lot of credit issuers that rely on commercial credit reports is not good of getting approved. But if your scores are good, you're lower risk, then you have a better chance of getting approved. Every one of your commercial credit reports says this recommendation of credit. It tells people flat out how much money you should be lent. This is available to anybody that wants to pull it. They don't even need your permission. And if you follow our Facebook live streams, you'll see we oftentimes go through real credit reports and we do reviews and we look just at this. What we do is we come in and we basically look at your risk or how much money you're being recommended to actually get approved for. And what's interesting is the more trade lines you have, the more accounts you have reporting to the business credit reporting agencies, the more money you're typically going to actually be recommended. Okay, that's what it really comes down to. So again, how much money you're going to be lent is based on what's recommended by the reporting agencies. The reporting agencies are issuing recommendations based on the data that reports to them. They're not going to recommend you should be lent $100,000 if the highest limit credit account you ever have on your credit report is $200. Now, again, you control this because the information that's reported to them through trade lines is what will ultimately determine the amount of money that's recommended that you actually be lent, amongst other factors as well. So again, D&B bases these dollar guidelines on historical analysis of the credit demand for companies similar to your business. So we're looking at others in your industry. Okay. Then we're also looking at, others in your industry that are similar employee size and industry. Okay. Then we're also looking at your payment history and how you pay. And they're looking at the likelihood that you're going to continue to pay your obligations. They're also looking at, again, your financial strength per your tax returns, the number of employees you have. So again, it's all these factors, most importantly driven by payment history, that's comprising that credit limit recommendation. So composite credit appraisal. So this is another credit score that you'll see on your report between 1 and 4 that makes up the second half of your actual rating, what D&B calls a D&B rating. So it reflects your overall rating of your business credit worthiness, your company payments, the financial information they have per tax returns, the public record, the business age, etc. I cannot tell you enough that when they don't have tax returns, they're really aggressively looking at business age and they're looking at employees to determine financial health. So if you are a newer business, a year, 2 years in business, and you have been crushing it with really good revenues, you probably want to supply your tax returns to D&B because that's going to make you a much lower risk than them just seeing that you've been in business for 1 year and have 3 employees. So if your financials are good and they're showing growth and they're showing higher revenues, well, then you want them to look at that data over employees and time in business, especially if you're a newer business, which is why you want to do it, because that factors into this composite credit appraisal, which factors into what's called your D&B rating, which is very popular. So if your company does not provide confirmant financial information, you cannot get a rating of better than a 2. Think about this. They're not even going to give you a high score unless they have your tax returns. And you are the one that controls whether or not they get the tax returns. So again, the 1R and 2R rating categories show company size only based on the number of employees. So again, this is what I'm saying. There's 3 different categories you can fit in. A, they have your tax returns. They know the number of employees you have. B, they don't have your tax returns, but they know the number of employees you have. C, they don't have either. They don't know the number of employees you have, and they don't have your tax returns. The least amount of information they have, the higher risk you're going to be. And if they do have the employees but not your tax returns, they make the decision solely based on employees, and you can only ever get a 1 or a 2R rating, which is on the lower end of the spectrum. To get to the higher levels, they have to have your tax returns to be able to have the best category of what is called a D&B rating, which, by the way, the reason this is important, it's the number 2 credit score that lenders and credit issuers look at behind the PAYDEX. They look at PAYDEX, then they're looking at what this score is, the D&B rating. So it's very important because the PAYDEX score is a reflection of how you've paid your prior bills. The D&B rating is basically, it takes into account your financial health of your business as well as past payment performance. So it takes into financial data into consideration, which is why lenders and credit issuers look at it so much. Okay, so again, they're assigned if your company's file does not contain a current financial statement, as we just mentioned, and the employee range ratings apply to certain lines of business not lending themselves to classification. So there's kind of a category for those that don't fit in to the actual normal categories. So the PAYDEX score, we talked about this briefly. It's called a dollar-weighted numerical rating of how your company has paid the bills over the past. So, as we talked about, past means performance. This score is based on your past performance, how you've paid your bills historically, okay? Dollar-weighted means that the higher the limit, the more weight it has into your overall score. So here's why this is important. If you have a credit card with a $1,000 limit and you have a credit card with a $10,000 limit and you ever had to go late on one of those, you'd always want to go late on the lower limit account. And the reason for that is because, again, the higher limit account has more weight into the overall score, okay? So the D&B PAYDEX score ranges from 1 to 100, okay? And higher scores mean better performance. So if you had 100, it means you pay the minute the bill even is produced, you pay. And if you have, for example, a 50 score, 50 literally means that you pay on average 90 days late. So it is based on exactly how you pay your bills. Now, PAYDEX scores reflect how well your company pays its bills. It's 1 to 120 days slow payments. Okay, 100 is prompt payments. Mid-range is about 50. Where you want to end up is you want to end up at about an 80. An 80 means you pay your bills as agreed. A 90 means you pay within the discount period. You get a discount if you pay within this period. And 100 means the payment's always early, like way early. So it's almost impossible to maintain a 100 score because you'd have to almost always pay your bill the minute the bill comes due, and that's not always possible. So for example, when I have an order shipped from Quill, I pay that bill immediately. But when I have an item shipped from Staples, Staples won't let me pay the bill. They won't let me pay the bill till the statement is populated. And I won't know when the statement is populated till I get it in my mailbox or I keep logging in every single day trying to pay it. Most people don't do that. Most people get a bill, pay the bill. So it's almost impossible to maintain a 100 score because a lot of revolving sources like Staples or Office Depot or most major retailers, you can't even pay the bill the minute that the item is shipped. You have to wait till a statement's populated. And in order to get a 100 score, you'd have to pay the minute that that's actually populated. So 10, we've talked about this, the D&B rating. Now, this helps companies quickly assess a business's size and composite credit appraisal. It's taking into account your financial data, as we've talked about, okay? So this is basically like your interim or fiscal balance sheet. It really has to deal with the overall financial health of your overall business. Now, the scale ranges from 5A to what's called HH, so that probably doesn't really mean much to you. But again, it's based on company size and worth. So it's based on your financial data and the number of employees that you actually have, okay? And again, they assign such a rating only if your company has supplied the information that they need. Otherwise, you're one of those other ratings that's less than this, indicating they don't have the financial information they need to come up with the real risk. So the rating contains a financial strength indicator. It's calculated using either the net worth or issued capital of a company. Okay, if both figures are available, then the net worth will always be used. So again, what we're talking about here is the financial stability, the financial health of the overall business. Now, D&B will show if a business is new or if they never got this information. They will say that right on the credit report. It also indicates a condition code or risk indicator to that effect as well. Okay, now it takes into account key items on the actual report which predict the likelihood of business failure. And we've talked about this. The financial data they have, the number of employees you have, how long you've been in business for, all those type of things are calculated in here. So by definition, a startup is considered to be high risk. Again, this is very, very important for you to know, because people think it's hard to get money as a startup. And here's why. Because the reporting agencies automatically default consider you to be high risk. Like I said, Experian and Equifax will actually even give you a failing credit score, even if they know you exist and because you have no credit. This is why you cannot avoid building business credit. If you want to have any chance of getting credit loans, credit lines, loans, you need to start focusing on business credit quality, because if not, the newer you are in business, the higher risk they think that you are, until you're like 5 to 10 years in business, where you start to move in to a classification of lower risk. Okay, bottom line. So the most important thing is that you can come in and start building business credit as a startup, start giving them a bunch of trade lines, giving them a bunch of data, which is what they ultimately want. Payment data, boom, here's all my information. Here's payments, I'm paying as agreed, I'm paying more. And the more of the credit you get, the higher your recommendation for credit goes, the higher your scores go, the lower risk you become of default. The better all of these scores are, the more lenders, the more credit issuers will give you more money. The more money they get, the more money that's reported, the better you pay the bills. Then all of a sudden you're controlling what's happening here versus them automatically giving you a failing grade because you have yet to get in there and get established. The same thing with tax returns. You have good tax returns, get them to them. Don't let them hold it against you that you've been in business for only 1 year. Let them know, hey, look, here's my tax returns. I might have been in business a year, but we did $250,000 in revenue our first year in business. And again, these type of things are directly in your control and will make you overall a lower risk. So recap, D&B gets your data from a bunch of different sources that we've talked about. You have control over some of these, such as your company website, what you see on Yelp, what's on your Facebook page, et cetera, et cetera. Paying on time impacts your scores more than anything else. That's the wonderful thing about the business commercial world that we live in, is that unlike consumer, where FICO scores are based on payment history and utilization and length to credit, new credit mix, primarily the scores in the commercial world are based on how you pay your bills. If you pay your bills as agreed, you get good scores. But in order to do that, you have to get credit that reports to the business credit reporting agencies. So it's very important to get credit that reports to them. Stop using your social and putting all this on your personal credit report, establishing the business credit, establishing the payment history, and that then increases your credit scores, it increases the recommendation of credit, and increases the limits that you're given for future credit that you continue to get. And again, it makes you a better lending risk. Okay, much of the report concerns D&B's predictions. Again, I'm going to say it's about half and half. About half their scores are predictive scores, and the other half are based on past performance. So the better you perform, then the less likely you are to default based on their predictions, which again is why it all comes down to payment history. And again, whether your company will fail, very important. Don't forget, they look at tax returns to determine financial health first, number of employees second. So especially if you have fewer employees, it makes more sense for you to then make sure that they have your tax returns. Okay, but past payment performance is no guarantee of future results. We know this. That's why there are performance scores, and that's why there are equal predictive scores. So that way a credit issuer and lender can have both. Look, here's how the person's performed in the past, and here's their score based on that. And based on all the data we have of similar companies in their industry, the financial data we have, the employees, the time in business, the past performance, here's our prediction based on all this data of what we think will happen. So now we know how they performed, and there's a score to that. We know how we think we know how they will perform. And here's the score based on that. As a credit issuer and lender, when you look at both, you have a very good overall picture of whether or not that person's going to pay you as agreed or not, because we're taking into account what they've done in the past, and we're taking into account all these other factors we found to be important to get an idea and paint a picture of what will happen and what will be predicted into the future. So that's it. We're going to wrap up. Again, hopefully this information is something that you found useful. Hopefully you understand. We went through a bunch of stuff, and some of it's confusing. You don't need to know composite appraisals and some of these specific scores that we go over. I've kind of talked more about the things that are important and how it's really relative versus all the geeky stuff that I like, right? Exactly how these scores work and how they break down. But now you have the most important information that I think can help you. If you have questions, if you want to talk to us about helping you build your business credit, condensing the process from years to months, or anything we can do to help you along the way of building business credit, getting set up with Dun & Bradstreet, building your credit reports with them, feel free to give us a ring, 877-600-2487, 877-600-2487, info@creditsuite.com. You can also go to creditsuite.com/monitoring. And at creditsuite.com/monitoring, you are then also able to get your credit reports for only $24 a month through our nav integration with D&B and Experian. And if you want to access even more free trading, then go to our website, creditsuite.com. At the top right of the page, you will find our social media links. We go live on YouTube every Tuesday at 1 o'clock, or almost every Tuesday at 1 o'clock. We also go live on Facebook every Thursday at 11. We're getting ready to change that to Wednesday at 4. And in doing so, our live streams, there's Q&A. You can ask questions. There's engagement. We do a lot of cool things that we don't have the ability to do on the YouTube stream. And of course, don't forget, we also have a podcast. About half of the people that listen to podcasts, they're listening while they're driving. So we've got a great podcast that has all different kinds of business credit financing tips. And we also go through some really successful entrepreneurs and do interviews with them with all kinds of growth tactics as well. So I look forward to seeing you next week. And I'm not sure, I should know the topic that we're going over next week, but I forget. But if you go to our YouTube channel, then you will also see the topic that we'll be covering next week. We usually have about 8 or 12 weeks of those planned out in advance, so you know what we'll cover every week. Thanks, everybody, very much for tuning in. If you have any questions, reach out to us and let us know. 877-600-2487, info@creditsuite.com. Thanks, everybody. Have a great day.